Alrighty, welcome to episode number 4 of The Upside with Eli. Today we are going through rapid fire questions. Maybe not rapid fire. We're going to do a thorough, explanation of them. But basically, this week is questions that people have submitted that they have questions about. So, welcome, Dylan. Thanks for answering questions with me today.
Yeah, looking forward to it.
Right on. So question number 1, how does the principal residence exemption work?
Cool. Yeah, basically what it is it just allows you to shelter the gains on your principal residence from tax. It can get pretty complicated if your residence is being switched between uses, like if it's a rental property for a bit versus a place you actually lived in, etc. But the base case is if you own a home that you've lived in as your main place of residence for the entire time you owned it, then you shouldn't have to pay any tax on any gains from the time you bought the property. That's the basics of it.
And what qualifies as a principal residence?
Yeah, so that's an interesting one. It's the definition is any place that is your habitual abode. So that doesn't necessarily mean, your main home here in Calgary. Theoretically, if you spend a good chunk of time out at the cottage in BC, you could decide to count that one as your principal residence instead. It just has to be a place that you and or your family uses regularly to live in, as opposed to, for example, a place that you rent out, right? That would then start to disqualify that. An interesting case is when people start using a place that could qualify as a principal residence for Airbnb. And that can lead to some interesting, especially because it's relatively new, can lead to some interesting conclusions by the CRA. But we'll leave that discussion up to a tax lawyer, tax accountant. But
Yeah, fair enough. And yeah, I mean the definition is ordinarily inhabit, right? So it doesn't necessarily have to be like your home or like a, like you said, but you just have to ordinarily inhabit it. And there's no specific timeline set by the CRA. So it could be, a couple weeks of the year. We'll often see, especially right now, we've got lots of clients with properties in the US that have gone up a ton in value. We've got one client, down in Idaho, and their property they bought for $500,000, and now it's worth $2.5 million. A decade later, there's a lot more growth in that property versus the property in Canada. So we'll use their property, stateside as their principal residence, right? Because they ordinarily occupy it throughout the year for kind of at least a few weeks, if not more, kind of in a given year, and people sometimes don't realize that your principal residence doesn't necessarily have to be domiciled in Canada, right? It can also be outside Canada. But yeah, the whole benefit is that you get for any one particular year, you can designate one property as your principal residence. And in years where you move houses, as you alluded to, it's kind of a plus one, right? So you can have up to 2 in 1 year for the year that you're moving. So they give you the year plus 1 year effectively, so that there's no overlap where you might accidentally have to be paying tax. And then I think where a lot of complexities come in is in terms of rental properties, because there's the +4 and -4 rules around if you had a rental property and then move into it and then claim it as your principal residence and you had no other principal residence, you could have up to 4 years of when it was a rental property claimed as your principal residence, and then vice versa. If you move out of a property and use it as a rental and you don't have another principal residence, you could use that property if you're renting it for no more than 4 years, right? So there's definitely a lot of nuanced kind of rules and stuff there, but ultimately, the principal residence exemption, you don't have to pay any taxes on the growth of your principal residence.
yeah, and I mean, like, there's so many nuances it depends on how in depth we want to get with these things, whether it's rapid fire or very slow fire, right? Because when you're talking about like properties in another country, depending on the tax treaty that Canada has with that country, how they tax the sale of properties, you might not want to, even if it's by far like has the more growth, you might not want to claim that as your principal residence because you might want to be able to use the foreign tax credits that you'd get from the sale from the other country. So, I guess how in depth do we want to go with this? Or keep it basic.
Absolutely.
The principal residence allows you to shelter the gains from tax. Yeah.
Right on. Question number two: how do flow through shares work?
I'm almost hesitant to even talk about them just because it is like, to be very clear, right? Like normally when we're talking about risk with investing, we're talking about, you know, the risk of a portfolio. We're spreading that risk around many, not only different individual investments, but asset classes and countries and industries, etc. With flow through shares, we're back to talking about like basically an individual. You can get fund to fund style flow through shares. But just to preface all this for people watching, there are tax benefits with these things, but just note that we are talking about individual investments for the most part that have a very real chance of becoming worthless. So you have to weigh the tax benefits against the potential to just lose all your money, in which case, of course, you're going to save on tax because you didn't make any money. You lost it all. That being said, basically a flow through share is when you purchase Canadian mining or oil and gas companies. Usually they're structured as limited partnerships or trusts. They're private investment vehicles, meaning you usually need to qualify through the offering memorandum route. They're not prospectus based. And basically what they allow you to do is, because these companies are going through like the exploration phase of mining and or drilling operations, they're not making any profits, right? And they're just basically racking up expenses as they're basically searching for minerals or oil and gas. So basically, in order for these companies to get funding on the market, it'd be almost impossible. So what the government allows them to do is flow through their expenses to the investor so that the investors can claim them on their tax returns. So that is the big tax benefit of them, is you can basically claim your pro rata share of their expenses, throughout the years that you hold that investment, as a deduction on your taxes.
Yeah, and generally it's in the year that you make that contribution, you can deduct 100% of your investment against your taxes. So we'll often see them utilized for people. Like I know we've got one CEO of a company, when he fully retires, he's going to get, right now it's looking at a $4 to $5 million payout, right? 100% taxed at the highest marginal tax rates. And so, we're looking at structuring, and there are lots of pooled options for flow through shares as well. But for him, when he'll have, zero income in the following year, what it allows you to do effectively is to say whatever you're investing is 100% tax deduction now, and then 1 to 2 years out, basically there's somewhat of a recapture, but it's actually taxed as a capital gain. So what you're doing is you're cutting your taxes in half. Now, the ultimate goal is to invest in something that basically loses less money than you're going to pay in taxes, right? So you're net ahead. Now, I've seen lots of flow throughs, and we've seen lots of flow through shares that have actually grown in value, and done really well on. And then there's lots that are effectively, that's what they're used for, though, is they're used to defer income from a high tax year to another tax year. And then you just, like you say, hope the investment doesn't do poorly. And the problem is right now is that most of them aren't even oil and gas related. They're just in, junior mining companies, which are, tend to be very high risk.
Yeah, like we are talking about basically the highest end of the risk spectrum. And yeah, basically the way these work too, right? So the whole, I didn't really touch on this, but basically there's a holding period associated with them, right? So you buy into them for X amount of years, it'll be set out in the contract. And then at the end of the holding period, usually in most cases, they're going to get turned into a mutual fund trust, where you can then sell units of, your units that you own in the open market. So there's also the issue of liquidity, right? Because those, you have to be able to find someone else who wants to buy this, those units from you, right? So it's not the same as, it's a mutual fund. Don't think like a normal mutual fund where it's extremely liquid. You can put a sell and like there's very little risk that those cells won't go through. Some of them, again, just depending on how they're structured, they might have like internal liquidity set up, but Just yeah, I like I said, the reason I was hesitant to talk about these is they do serve a purpose, right? And like that is the classic scenario, right? If you've got athletes who, just signed a contract with a big signing bonus, if you've got CEOs retiring or getting laid off and getting large severance deals, right? Anytime where you're getting a massive lump sum of income and you want to kind of try to defer that or spread it out over a couple of years instead of all at once. That's what they're for. But just, for anyone watching, just be very careful with these types of things because they are extremely high risk investments.
Totally. And the key part is that you want no income or very little income in the future years. So even with things like severances and stuff like that, usually don't make sense because you're just going to get another job again and you're still going to be in a, relatively high tax bracket. So, usually we only, kind of utilize them for those, kind of more unique one-offs, but you'll see lots of people talking about them online. But yeah, there's some great tax benefits. They're incredibly high risk. Like you say, on the highest risk spectrum. And yeah, there's just, a lot of it is very investment dependent, right? So there needs to be a lot of due diligence on them.
Yeah.
All right, next question. How does income splitting work?
Income splitting, man, this is a big topic, but basically income splitting is, in my opinion, it's one of the biggest, best tax planning strategies that we have in Canada as just like an overarching strategy. The basic premise with income splitting is getting more income taxed in the hands of someone who's in a lower tax bracket, right? So trying to shift income from someone who pays tax at a high rate to someone who pays tax at a lower rate. That's where you're splitting that income. So for example, our ESPs technically are accomplishing income splitting. Right, they have some other benefits too, and of course you're getting government matching. But effectively, what you're doing with RESPs is you're taking money from, as the parent or the grandparent, you're taking money from your hands. That would be, the investments would be taxed in your hands at your most likely much higher tax rate, and you're moving it to the account where ultimately, when the money's drawn out of the account, it'll be taxed to the beneficiary's hands, the child's hands, when they're going to school, when they're probably not making a lot, if any, money and paying very little to no taxes. That's a version or a form of income splitting. With income splitting, you save tax. This is like the key thing. You save tax at the difference between marginal tax rates. Right? So what that means very simply, just using made up tax rates, if you have someone in a 50% tax bracket and someone in a 25% tax bracket, every dollar that you shift to the person in the 25% tax bracket, that's going to save you, both of you as a couple, as a family, whatever it may be, 25% in tax. Really what's happening is the person in the lower tax bracket is going to end up paying more tax at 25%. The person in the higher tax bracket is going to pay less tax and save the tax at 50%. So you're saving tax on the difference between the two.
Yeah, and I would add that there's two types of income splitting. I mean, there's lots of different versions of it, but ultimately there's one where you're earning income and you want to build wealth and create it by reducing your taxes as much as possible. And then there's on the upside where when you're drawing out of your assets and pulling out from it, whether it's RSPs, pensioning, and that kind of thing, you want to make it so that you're paying the same amount in tax as opposed to one spouse being in a way higher tax bracket. And I think, some of the most common ways to do that are things like spousal RSP contributions. Works in two different ways. One, you're able to get a tax deduction for the higher income earner, but also on the flip side, when you're actually withdrawing funds, you're able to equalize it because each of you has, the same amount of money in RSPs in an ideal scenario. Or if you're over the age of 65, you can actually fully income split by drawing out of each spouse's RSPs or RIF at that point and having it attributed to the other spouse. So in Canada, we just have more challenges than for example in the U.S. because yes, you file a tax return, you name your spouse on it or your common law partner on it, but you actually don't file jointly. You don't get to divide things as a family. And so we're constantly looking for different ways that we can lower the net household tax liability owing. What would you say are some other examples of income splitting?
So the first thing I'll say is kind of responding to that, and it leads into some other examples, because like income splitting in Canada, once you reach age 65, becomes a lot easier. RIF income, LIF income, you can split once you're 65. Pension income, you can split 50%. CBP, you can share that. It's not exactly 50%. There's some extra calculations, but like you can split most forms of retirement income pretty much 50-50. Income from
Yeah, TOSI falls off, tax on split income from corporations.
right.
Yeah.
Whereas income splitting
Assuming
is,
that the other spouse is on the corp.
yeah, exactly. And so income splitting is a lot easier in 65. You can't talk about income splitting though without talking about the attribution rules, which is what makes it so challenging to just, you can't just give money to your spouse and just say on your tax return, I want half of my income to be taxed in their hands, right? Which isn't exactly what happens in the US, but kind of to a certain extent, right? Canada's very punitive actually to like stay at home families. But some other examples, I'll talk about the attribution rules quickly. Basically, there's quite a few rules that limit how much or when or how you can split income with different people. So, for example, you can't just gift funds to your spouse and have the investment income taxed in their hands, right? But some strategies you can do to basically affect that. There's some extra steps you have to take. One is the spousal loan strategy. Right. So basically you're actually technically loaning funds, and it has to be a real, like it has to have a promissory note attached. And basically it has to be a formal loan structure where the spouse, the one who would be in the higher tax bracket, who's trying to split income with the lower income spouse, would make a loan of funds for the purposes of investing to the other spouse. That spouse gets taxed now because it's a formal loan. Basically, there was fair market value consideration in the form of a loan. So that spouse is going to get taxed on the investment income, and they have to pay the loaning spouse interest. And the spouse is going to have to claim that interest on their tax return. And you have to pay interest annually. You can't not pay it. Otherwise, it voids the structure and you get tax penalties. So another option is called second generation income, right? Which is basically the interest that the interest earns, right? Or the gains that the gains earn, et cetera, et cetera. So that's one way where you can kind of just gift money to your spouse. And then eventually more and more of that investment income is going to be taxed in their hands instead of yours. Another fairly simple one.
Incredibly difficult to track, but yes, definitely doable.
And a key part of this is so many people have joint accounts. If you're in a province where there's high probate fees, I tend to use joint accounts for spouses. If you're in a province where there's little to no probate and there's not, a significant benefit or reason to try to avoid probate and going through the will, I oftentimes will set up 2 individual cash accounts for spouses so that we can more easily, it doesn't make it perfect, but it makes it a lot easier to track things like income splitting, like transferring capital losses when those are generated. It's another kind of way of income splitting. But yeah, just note, if you do have joint accounts, like you're going to need a really good bookkeeper and or accountant to help track these things if you're doing them, because it's really hard to track that. For example, another strategy for income splitting, and I'll get to the easiest one in just a second, but another good one is, like, for example, if one spouse owns their vehicle, right? The other spouse could purchase for fair market value, right? You can't pay $60,000 to your spouse for a vehicle that's worth 5, but you can pay 5 for a vehicle that's worth 5. Now that money is legally belongs to the spouse who sold their vehicle to the other spouse. It's called a transfer of assets at fair market value. So because you actually paid a fair price for the thing that you bought, now that income again, or that money is again owned legally by the other spouse for tax purposes. So now the investment income is taxed to their hands. Think of like the nuances of trying to do that in a joint account. How do you show that you took out $5,000 from your joint account to then pay $5,000 into the joint account, but it's actually coming from one spouse to the other, right? It's a nightmare to track.
And you'll definitely find certain accountants that just don't, like, they just refuse to deal with that type of a structure, right? They just tell their clients, don't do that, right? Even if you're doing it from a potential estate standpoint, they just really don't like it. Some accountants are okay with it, and some accountants really don't like that. Yeah. So, that's what we've run into quite a few times, where a client wants something, or one accountant wants it one way and another accountant does not want it done that way.
And that's, usually the case when you start getting to more advanced like tax planning strategies is, people forget or don't know that, the tax code is not like a set list of rules of things you can and can't do in every situation. It's guidelines for interpretation, right? So you could have two different accountants, two different tax lawyers who give different answers for the same situation, right? The easiest, one of the easiest anyways, simplest strategy for income splitting that works really well for people who are growing their wealth right on the way to retirement is the higher earner pays the expenses of the household. What that does is it frees up all or a lot more of the income of the lower taxed spouse to save and invest, right? And so now that investment income is going to be taxed at, one of the lower tax brackets as opposed to a higher one. All of these things, for the record, are basically unnecessary until you've maxed out your register, like your tax shelters, your RSP and your TFSA. Those are the simplest ways to get significant tax savings and benefits. If you're
That's what I was going to say. When you say what's the easiest way to split it, to split, it's you can't gift money to a spouse to contribute to their RSP, but you can gift money to a spouse to contribute to their TFSA. So that would be number one, the easiest way to kind of structure things.
100%.
But yeah, I cut you off there.
No, and that's where I was going with it, right? You can. It's no problem with the TFSAs. With the RSP, there is a nuance. You can't contribute to not a spousal RSP, but a spouse's RSP. However, if your spouse makes 50 grand in the year, for example, you can pay $50,000 worth of expenses so that they have their full $50,000 to contribute to their own RSP. Whether or not you'd want to do that for other tax planning purposes is a different story, but that's how that works. But if that spouse, for example, contributed $55,000 to an RSP when they only make 50, now the CRA is going to have some questions, right?
Well, that and does it even make sense to contribute that much? Or I guess if you do contribute that much, deduct that much in a particular year. But yeah. Income splitting ultimately, to the individual who asked that question, it's just ways to equalize the amount of tax, paid by multiple spouses, or if you get into trust planning within families, and just ultimately the end goal is to reduce the overall tax liability of the family unit.
Yeah, exactly.
Cool. Next question. Should I take the commuted value of my pension?
Okay. Well, full disclosure, my answer to this is usually yes, because I manage, retirement investments for a living. So I'm more than confident that we're not going to lose that money and all that. But obviously it's a more nuanced answer than that. For one thing, it absolutely depends on who's going to be managing that money once it's out of the pension, because this is your life savings. It's meant to provide an income for life. So this is not something that you should take and, take your committed value and then toss it into cryptocurrency 100% and just, do stuff like that, which is something that some people do. So the first thing of whether or not, if you're looking at pulling the committed value, determine whether or not you have someone, or if I wouldn't recommend it. Investing is a lot more complicated than people think it is, but if you think you're confident and capable yourself of managing it, but you need to have someone who's capable of managing investments for retirement, right? And making sure that that money obviously needs to grow. It needs to keep pace with inflation. It needs to be tax efficient, but you can't lose it all, right? You can't run out of money in retirement. That's the disastrous part. And that's what you're giving up if you leave a pension plan, a defined benefit pension plan, is you're giving up that guarantee of income for life. We can talk about funding of pensions and, are all pensions perfectly 100% guaranteed? We could look at companies like Sears, which were one of the biggest companies in Canada before it went bankrupt and all that stuff. But, if we're talking about like a government pension plan, unless the government of Canada collapses, right? Your income is more or less guaranteed. So that's what you're giving up. Now, the big reasons that people, and a lot of business comes from this, the main reason that people look to give up that guarantee is for all the things you get in return. So first things first is you now have control over your investments, right? How they're managed, the level of risk and return that you're trying to get, right? You don't have to get more aggressive with your retirement investments by pulling the committed value. You have the option of doing so. You could also invest the funds yourself just as conservatively as they would be invested inside the pension plan. If you do, pensions usually invest very, very conservatively, like shockingly conservatively, if you actually were able to see what's going on inside the plan. So a lot of people choose to take a bit more risk with the funds and try to get a better return, which allows you or would allow you potentially to be able to spend more, have more money in retirement. Some of the other big reasons come down to estate planning, right? Because I make the joke, like, pensions are effectively a mild form of communism, right? Everyone pools their money together so that if one person dies young and one person lives for a very long time, the person who dies young, a lot of their money is ultimately going to fund the retirement of those people that live for longer. That's how pensions, or that's one of the main ways that they're able to guarantee the incomes for life. That and increasing contribution rates on the people currently contributing and working to the plan. So if you're not married to the idea of having, guaranteed income for life, and you're willing to just do smart things to make your own money work for you, one big advantage of taking the commuted value is the ability to keep what's yours, basically, right? So any money that you don't spend during life, once you've transferred it out of the pension, is available for example, your spouse to spend. And any money that you both aren't able to spend during your lives, that gets to go to your children or charity of your choice, or anything else you want it to, as opposed to inside the pension plan, quite a few nuances. It'd be worthy of like its own video, to be honest. But you can get some payouts if you pass away with the pension, but a lot of that money is going to go towards funding the pension of those who remain, if you will. So those are the two biggest benefits: potential to increase your return and the amount you can spend in life, and the ability to leave more to those that you wish once you pass away.
Fair enough. Yeah, I would say I'm definitely a little less biased in terms of should I leave it in versus, kind of take it out. I think ultimately, when you're trying to determine the commuted value, you should look at a few things. One is, what are prevailing interest rates at the time, right? When interest rates are higher, your commuted values can be lower. When interest rates are lower, your commuted value is going to be higher, because what that's based on is, at current rates, what lump sum do I need to generate that same, kind of payment on an ongoing basis, right? As you do a TVM calculation. And there's a whole bunch of calculations behind the scenes. And if you've ever actually, sat down with an actuary and looked at the spreadsheets and stuff they have as they're building these things out, they're actually very, very, incredible spreadsheets that they use. So I would look at, what are current interest rates at? I would also want to look at the funding of the individual pension. So again, you can hire an actuary to look at it very specifically and say, all right, how well funded is this pension, right? Is there a risk of it, of it being reduced because it's not performing well, right? So that's another consideration. Another consideration might be, what is the actual investment makeup of the pension, right? There are a lot of illiquid and alternative investment structures within a lot of pensions that you may not have access to outside. So there may be advantages from a diversification standpoint to invest and keep that money within that pension. Now, on the flip side, I would look at, what is your longevity? Do you have a reduced life expectancy? That'd be a great reason to want to take a commuted value, because you're probably not going to get your money back if you've got heart issues or other kind of like health issues. There's the part of, do you care about leaving money behind to other individuals, right? Is that something that's important to you? Because you can have guarantee periods put onto a pension where, if you die, 2/3 continues to get payout, or 100%, or if you die, the next 10 years are guaranteed to get payout. You can have all these kind of different structures there. But for people who, maybe have, knowing that they want to leave money behind, they don't really care. They might want to leave in that pension just to have that guaranteed income for themselves. Now, as you mentioned, is it guaranteed? Is it not guaranteed? I mean, part of that's going to depend on the, how well funded that pension is. So I don't think it's as cut and dry as everybody, should take a commuted value. When we run the math, most of the time it does make sense to have a commuted value, because of just how vast the investment landscape is now in Canada, and how easy it is to get access to all the products that exist, within that pension structure. Anyways, most of the time, we can get a better rate of return because we're not limited to the needs of the overall group of individuals, right? When you have a pension, you have consistent payments that need to be made every month, every year to all these plan members. Whereas if it's just you, we can build a customized portfolio specific to your needs. When you combine that with the fact that, you're not walking away from a whole bunch of money if you die early, that's why most people, in my opinion, end up taking a commuted value, is exactly for those two reasons and the control factor.
And I forgot the biggest reason why it's helpful to take the community value. And to your point, if you're a single person with like no one to leave the money behind, you don't have any charitable goals, anything like that, and you don't want to try to get a better return, better more income yourself, then yeah, like obviously the estate planning parts of that don't apply. But the biggest thing, and I can't believe I forgot this, is the ability to spend more upfront, right? Pensions are going to pay you, it's indexed to inflation, which is awesome. Well, hopefully it's indexed to inflation. It isn't necessarily, but most plans are. But
or a version of inflation.
Yeah, like yeah,
right to a max.
But most retirement plans, you don't spend money in a straight line. You're not spending the same amount when you're 65 as you are when you're 95, right? You're just going to naturally, again, most people naturally decrease their spending with age just because you're getting older. You have less stuff to spend money on. You're doing less things. Of course, there's like long-term care needs and other factors. I think there's other really strong ways of accounting for that beyond spending in a straight line. But the big advantage is, being able, if you take the community value, now you can spend more upfront, right? Front load your retirement, spend a bit more money when, again, within the context of a financial plan, you've actually calculated this stuff and you're not just guessing, but spending more money when you're younger, healthy, so you can really enjoy your retirement, right? Make the most of what you've been saving up your whole life for. I want to challenge you on the present value stuff, on the calculations, because that's exactly what the calculations of commuted value are. It's a present value calculation saying at current interest rates, how much would you need to invest today to create the income promised you from your pension plan? So if interest rates are higher, you're absolutely right. Like, and for anyone, just to review, if interest rates are higher, right, the commuted value is going to be lower, all is equal. And if interest rates are lower, then your commuted value is going to be higher. It actually doesn't make, theoretically anyways, mathematically, it doesn't make a difference because we're still just calculating how much you would need to invest today in order to get that stream of future payments at current interest rates, right? So if the interest rates are a lot higher, right, the rate of return inherent in markets is higher when you take your pension, you're going to get a lower amount up front, which might seem like it sucks. But what's actually going to happen is you should be getting a higher rate of return moving forward, right? It offsets. That's quite literally how we calculate it. And the other thing to consider is taxes. If you get you have a maximum transfer value, which is how much you can pull out tax deferred from your pension. And so if you have a really big commuted value, because interest rates have plummeted back down to like 1.5%, you actually run the risk that quite a bit of that's actually going to get taxed if you pull the commuted value. And so you'll have less left over after tax. Whereas if you get a smaller commuted value, it's a lot less likely that you're going to be over that maximum transfer value. And so you should be able to fully transfer all of it tax deferred into, a LIRA or an LRSP and eventually, into like a RIF account. So as always, the answer.
Yeah. And then that brings up another good point too, is part of it is how much room do you have in RSPs? Right. So when you have that amount and, for example, we did a ton of commuted values from like 2015 to 2018, right, where you had people getting, $300,000, $400,000, $500,000, $600,000 in the additional cash portion. Right. If you've got $300,000, $400,000 worth of RSP room, boom, like that's a no brainer. But like you say, if you're going to take the community value and it's going to be way bigger and you're going to lose a whole bunch of that to tax, it might be another reason why maybe you want to leave it in the pension or you're right. There's other factors, kind of involved there. So I would say there's, a few major factors for every individual. There's maybe a dozen factors, kind of that affect decisions in general. But ultimately, it's going to come down to, as always, your personal circumstances and your personal situation, whether or not you should take that.
Yeah, and also if you want to retire before 55, because most pensions, that's the limit. If you don't take your commuted value till after 55, then you don't have that option anymore for a lot of pensions.
Totally. Yeah, you just don't have that flexibility too. And then yeah, it depends too, like you said, if you have other assets outside and what you're going to live on, or if that's like 100% of your retirement, like there's all those different pieces. So but yeah, that's all the time we got for today. So thanks for joining me today, Dylan. And we'll see you next time on the Upside with Eli.
Thanks for having me. It was funny. This is supposed to be quick fire, and I think we got to what, three things, and then just talked about them very in depth.
Yeah, we got five. Well, I
Oh,
said
we
at the
did.
beginning, I said, okay, we're not doing rapid fire. We're gonna do in-depth fire.
Fair. Okay. Yeah, that was good. All right.
All
Well,
right. Thanks, Dylan.
thanks. Have a good one.